Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
All right, everyone. Welcome to the show. Pleasure to have you with us today. In the studio with me, Victor Kumar and Steve Waters. You might have heard them on the show beforehand. They're from the Right Property Group. Guys, how you going?
Going well, thank
Good,
you.
Phil.
I'm going to put it in your hands, Steve. What do you want to talk about today? It's up to you. You're in control. You're in charge.
That was not in the plan.
No, there is no plan.
I think state of the market. Let's talk about the market around the country and everyone's perception.
Okay. Well, everything's stuffed, isn't it?
Yep.
Everything's gone. Don't invest in property.
Sell everything.
Sell everything. Get out.
Yep.
Put your money in Bitcoin.
Crypto.
100%. You reckon?
No.
How bad is it? Is it blood on the streets? I've been getting a lot of information from CoreLogic recently. They pump out stuff, so much you can draw whatever decision you want to make. You can find it in looking at CoreLogic information. There's a whole bunch of different metrics you can use to work out what's going on with markets. There's vacancy rates, there's price growth, there's vacancy rates, there's all and sundry. How bad is it out there in Australia as a property investor right now, Steve?
I think it depends where you hold that property, but generally speaking, I think it's okay. We're getting back to a level of normality is how I see it. There are some areas that have contracted in price for sure, but let's not forget that we've also had in those same areas probably 75% growth over what we would consider a short period of time, like 5 to 7 years. So if you've got an asset that's grown by 75% and it's contracted by 10, I'm okay.
Why does every single media outlet, except for Smart Property Investment, talk about this doomsday predictions around and I'm going to a particular reference, and this is the turn to media outlet for me when I don't want to do anything else and I want to sort of ease my headspace. The Daily Mail, you'll have some young journalists there writing about bloodbaths and property investment. Why is the media getting behind it in the way they are? And do you think it's misinformation, or do you think it's polarising investors, or what's going on?
Look, I think there may be a slight agenda behind it, but I think just generally speaking, it's misinformation and bad news sells at the end of the day. I mean, let's be real here. It was like someone flicked the light switch off and they've gone from reporting all the good news stories and how well the markets are doing and how to become a millionaire in 3 days to just overnight suddenly it's doom and gloom and we told you so. So I think there's a lot of misinformation there.
So we're talking specifically about the Sydney property market right now, which seems to be getting all the headlines, right?
Sydney and Melbourne, yeah.
Melbourne is softening, not to the level as the Sydney market, but it's at a different state of its cycle. So we'll continue to watch these reports coming out from CoreLogic around. They typically deliver their information based on quartiles, right? Upper, middle,
correct,
and lower, right? And some parts of the market are softening faster than others. That's in the Sydney and Melbourne market, but there's other areas, and I think of Tasmania is growing at, I think, all quartiles at 10+%, right? So markets within markets, and people use this term all the time. There's markets in markets, there's different markets within suburbs. It's just property speak, but what does it actually mean?
Well, it means that no two markets are the same, and they will.
What's a market?
Well, how you determine as the investor a market, it can be from a broad base, so we can go state-based, or we can go down to council areas, we can go down to suburbs, and sometimes even streets, the market within the market, and we see that quite regularly, where one street will perform better than another for whatever the reason. It might be a flood-affected area, it might be a busier road, or it might have a bad rap or a bad stigma. But I think generally speaking, the evolving markets and the contracting markets, and essentially because there are markets within markets, gives the investor a very, very good or that gives them the ability to have good diversification, because if you are going to invest, you'll be looking for the next market, and that gives you diversification.
Where do you sit with all this, Victor? Are you you got your head in the hand, you're crying yourself to sleep every night in a fetal position, worried about your portfolio and your personal wealth, or you're thinking opportunities?
I'm thinking opportunity, and the opportunity doesn't come by doing the same thing that you did when the market was absolutely roaring towards its peak. It's adjusting your strategy to take advantage of what's happening in the market right now, and adjusting the strategy that's more in line with a softening market. So a good example would be buying properties that have got a twist. In other words, renovation potential. Just like if we go back years back, your Cambridge Park property, that was an opportunistic purchase, it was particularly in line with this strategy with what the market was offering back then, to capitalize on it and create the growth rather than waiting for the growth to happen.
So this is an important point. You're talking about adjusting your strategy rather than changing your strategy. And having spent a lot of time speaking to investors, one of the major mistakes a lot of people say is that they go, I've changed strategy multiple times and therefore never really known what I'm doing. So you're talking about adjusting the strategy. Can you explain the difference?
Yeah, absolutely. So when we're investing, we are investing towards an outcome, right? And that outcome needs to be forefront of mind to say that this is what I'm trying to achieve as I'm investing. And what you're doing then is correcting your course with the market forces to still be aiming at that goalpost, rather than saying, you know what, I'm done playing this game. I'm going to go out and play something else. And that's the biggest difference I see in terms of adjusting your strategy rather than changing your strategy. Changing your strategy could be something as something like, I've tried. Established properties, and I'm going to go out and buy off-the-plan properties. There's a total change of strategy in that sense. But we're trying to, let's say, be in established properties. So we're changing what we're trying to do. Is it value add? Is it land banking? Is it moving into a different market with higher yields or higher growth prospects?
I think all the markets have a slightly different strategy.
Correct.
At different cycles, so to speak. But I think, generally speaking, going from a black and white change of strategy is very dangerous.
So if I think my portfolio, which I chat a lot about on the Bumper Investment Show, Steve, an adjustment of strategy would be, say, to summarise the strategy that I have towards property investing is to identify and buy under market value property, which I can realise good capital growth over time, and try and minimise the holding costs as much as possible. So reasonable yields, good yields, but with capital growth play. So adjusting my strategy would be buying heavily in the Sydney market at a point in time, and adjusting my strategy to say Sydney doesn't offer those opportunities anymore. I'll do exactly the same thing, but I'll do it in Brisbane. Mm-hmm. That's adjusting your strategy.
That's it, yeah. Or buying a particular, if we go to your North St Mary's property as an example, which was purchased for multiple reasons, one of which was it could be a duplex site.
Yep.
So adjusting the strategy might be, well, now it's time to knock that house over and build the duplex. And it's not, but eventually it will be.
Yeah. Interesting.
Controlling the opportunity.
And that's what your strategy needs to be set around, is that understanding where those opportunities are, what you're going to be doing with those opportunities now and into the future. And property is not a short-term game. But for some people, a strategy might be to buy, renovate and flip, right? That could be a strategy.
But that's also dictated by the market as well.
Absolutely. So this goes back to markets in markets. And there would be an argument to say that even though the city market is in a softening thing, if your strategy is to buy, renovate and flip, I'm sure there's opportunities like that in the city market if you know how to go about identifying where they are, how to do it most cost effectively, and what the upside benefit is going to be over time.
100%.
Yeah. Okay. So there's lots of different strategies in property investing. Not all strategies are the same or equal, but the strategy needs to be right for you.
Needs to be created around your financial footprint.
Okay.
Yep.
What's a financial footprint?
Affordability.
Okay.
To your hip pocket at the end of the day, so the household income and
ability
budgets.
to hold the property, ability to hold your property portfolio should be the critical factor for nearly every single property investor.
100%, but it also needs to be the household budget needs. So if you've got a family or not, that's relevant, I suppose. But being able to just support the property isn't good enough. You need to still live. There needs to be a quality of lifestyle.
Yeah.
So that. And not in today's market, so not while rates are low, not while the markets are growing, but look at it from a worst case scenario. So when the markets aren't growing, when the rent is low, when the rates are high, how will you sit then? And that should be forming your strategy.
Build your worst case scenario and plan around. Okay, cool. So to summarise, the current Australian property market is a big market, so you probably shouldn't even reference it. I think it gets pulled into World Bank data and say it's one of the most expensive property markets in the world. And the way they base that is income over debt.
Yep.
And we rank really high as a nation. Sydney in particular ranks really high as a percentage of income versus debt. But we sit there with London, New York, Tokyo, all the big cities
which isn't
of the
often
world,
talked about.
Which
Correct.
isn't often talked about. And a lot of, and even today, a lot of international people think property in Sydney is cheap and really well valued.
Which isn't often talked about.
It isn't often talked about.
It's a world-class city, and I think people forget that.
Same with Melbourne.
Same with Melbourne, yeah.
And Brisbane to a lesser degree, but it's sort of moving in the right direction. It is a world-class city in terms of accessibility to Asia, locality to Asia, ability to connect in with Asia. So over time, it's going to show those growth and drivers.
And when they talk about the real estate market, which not just what state are they talking about, but what particular asset vehicle are they talking? Commercial, industrial, residential. It's a big market out there.
Yeah.
And every state is at a different point in the cycle, and often a really good gauge of that is consumer confidence around that particular state.
Okay, so consumer confidence drives
spending,
and there's macro and microeconomic factors associated with that, and we've spoken about them a lot, but let's quickly do around the grounds and see what's going on in Australian property markets, and we're going to generalise here. Let's go two ways: capital cities versus regional.
Okay. You want me to kick that off?
Yeah, but let's not talk about specifics. Let's talk about regional markets versus capital city markets.
Okay, regional versus capital city. So
outside of your metropolitan basins, Sydney, Brisbane, Melbourne, Perth, Adelaide.
Okay. Sydney, it's consumer confidence is contracting. Prices are contracting. People generally are starting to hang on to money rather than spend it. And that's city-centric, so we're talking in the basin of Sydney. Regionally, though, there's a little bit more consumer confidence. The drought, having said that, may knock that around, and that'll have a direct effect.
100% of New South Wales is in drought, I read today.
100%.
100% is in drought. And we talk about regional markets, and regional markets here we talk about Sydney versus the rest of New South Wales. So Wollongong, Newcastle, they're sort of metropolitan, but
yeah, Wollongong's had its run and it's certainly softened. Newcastle has had its run and it's certainly softening. I know there'll be people out there that'll disagree with it, but if you were hell bent on buying in the Sydney basin and maybe just on the ebbs out, I'd be maybe looking at parts of the Central Coast, especially with that infrastructure, with the tunnel now coming at the end of the whatever they call it.
Yeah, M1.
M1 to bypass all that Pennant Hills Road. So that'll open up that corridor just a little bit more, even though it's had fantastic growth. Brisbane.
Let's stick with New South Wales. So let's talk true regional markets. So Orange, Dubbo, Bathurst, Armidale, Tamworth. That's pretty much all the major ones.
They're going to feel the effect in terms of confidence as a result of the drought, I believe.
So farmers ain't got as much money to spend on stuff, and that's going to impact local economies. It's going to flow down all the way through to jobs, your bottle shops and your coffee shops and all this sort of stuff.
And that it might not be instantaneous. It may take months or even 12 months for that to happen.
Okay.
But it'll quickly turn around again. So the regional areas for us, or for me, is more around something or an area that isn't reliant upon one industry. So agricultural, it needs to be manufacturing and have multiple streams of income, so to speak, into that small economy or into the local economy. That will give you mitigation in terms of the ebbs and flows of prices and population growth, because the regional centres are, as it is all real estate, but more so than not, regional centres are at the absolute beck and whim of population growth, because it's condensed.
So the same holds true, I imagine, Victor, for Queensland, same dynamics. So you've got Brisbane, the capital, versus regional areas. And regional Ipswich is probably Ipswich is like the Geelong of Melbourne, or the central coast of Sydney. So it's sort of part of the greater Brisbane area. But I'm thinking sort of Cairns. If you want to go to your mining towns like Emerald or those sort of areas, what's your feelings and sentiments towards them versus Brizzy?
Look, when you talk particularly the mining towns, a lot of people have chased the phenomenal growth, the phenomenal yields in those areas. And if you are getting into the mining towns, once you really read the market, you really want to be the first one in and first one out of that market. I'm not a strong advocate of buying in mining towns for that reason, because if you mistime it, you're done. right? Because then you
You're
have
out,
to wait.
you're dusted, you're potentially bankrupt,
pretty much.
which we know happened to a lot of people who
Yes.
speculate in these areas in Port Hedland, etc.
Exactly. Yeah. And then when you come to the regional markets, it depends on how you define regional markets. So as you mentioned, Ipswich for some people is regional, for other people it's metropolitan. It needs to come back to obviously accessibility, transport accessibility back into the main CBD, and also what's happening within the area itself. And what infrastructure has been put in place. So if you look at, say, Ipswich as an example, there's a lot of infrastructure going in there, particularly with the hospitals, the road network, and so forth. Yeah, and so it's brought that area that much closer to Brisbane. Yet it's its own employment hub as well, because you don't need to get out of Ipswich to hold a job. Even during the hard times, there are many stable employers within that area. So we need to look at it from that term and say that, okay, whilst it may be regional, considered regional by the postcodes or by some of the bureaucracy, it doesn't look and doesn't feel regional, and therefore taking into account the travel distance to Brisbane CBD and even up to the Gold Coast as well, it's not that far.
Gold Coast is regional, really.
Yeah, pretty much. Yeah.
Well, if you're going to call Ipswich regional, then the Gold Coast would be just in terms of distance.
Yeah. So,
but I think, sorry, Phil, with looking at investing in these areas, we need to be looking at it from two viewpoints, right? How easy it is to get in, and equally importantly, it must be substantially easier to get out of that market, so that once, let's say, the property does not suit your needs due to change in circumstances, whatever they may be, you are able to offload that property with ease and move on to a different market.
So you can go right across Australia like this, and it's going to be exactly the same conversation. So, Steve, you think of Victoria, so Melbourne is the major capital, but you've got Bendigo, Ballarat, Shepparton. These are big regional centres. So the same logic holds true. A lot of those regional centres are self-contained little micro ecosystems, and Ballarat, for example, has all the trappings of a satellite city in its own rights. You can live there and never leave there, and everything is there for you. And as long as there is job growth, economic growth, driven by multiple economies, they're not going to be bad investable locations.
And for me, it was such an obvious choice, Ballarat, Bendigo, Geelong, because often investing and well, not just investing, but price growth is around about affordability, and it's every cycle it doesn't change. As the top end of town perhaps becomes unaffordable for the majority, everybody just goes to that next ring, whether that be a price ring or whether it be a geographical ring. And when you've got good infrastructure such as Geelong, Bendigo, Ballarat, Geelong in particular, and it's not that far back into the CBD, eventually the prices are going to increase, and they're going to increase rapidly, just as they did in the western corridors of Sydney and the like. It's almost predictable to a degree. And they also have a better degree of cash flow around them. So as an investor, I think you just need to make the decision on whether you want 10% growth just for maths figures of $1 million property, or 10% growth of a $300,000 or $400,000. What will you be happy with?
So how do you work out whether or not regional is right for you guys? So do you ever invest in regional?
Yeah.
Do you hold any regional properties personally?
Yeah, Geelong. If you come back into Sydney, into New South Wales, Dubbo, Orange. So regional is for me, regional needs to be an exact thought, needs to be an exact or an execution at the precise point in time. Otherwise, you don't have the growth, perhaps. You don't have the cash flow. It should be part of the portfolio, not the portfolio.
So you might be generalising, Victor, but regional properties typically yield better than metropolitan properties. A lot of people, and the point you've made around pigeon pairing, you might have a capital growth play in a metropolitan market, but your regional property might be the generator of the cash flow to help you hold the metropolitan property better.
Correct. Yeah, but you've got to keep it in perspective in the sense as well that, especially in a regional area, your cost to hold, in other words, repairs, maintenance, and management fees, is generally a lot higher. So you have to correct it for that as well, and then look at it in its true numbers rather than just looking at gross numbers to say that it is going to be a really good investment property.
Okay. What do you guys think about Tasmania? Is it done? It's looking at these CoreLogic data, it's grown 10+% over at least the last year or so, and probably more.
We did Tasmania probably 4 years ago, not a lot, but a little bit. And it's no secret, it's had tremendous growth, and it had great cash flow, and even to what maybe now it still does. For me, because Tasmania is a regional area, well, in particular Hobart, and I can just hear
You're going to cop the flucker
I
in
know,
there.
right, as soon as I said it. But it's, to Victor's point earlier on, how easy is it to get in and how easy is it to get out? And whilst there's probably a place for Tasmania in your portfolio, I certainly don't think it's should be the portfolio.
So it's a timing thing for a lot of people. We've got to remember Tasmania was
timing.
flat for a
Very much
long
so.
time.
For about 10 or 15 years.
Yeah.
And people need to understand just catching up what it didn't do. It's very typical to Sydney, during the GFC and post-GFC. But the thing that I would be looking at as a Tasmanian investor is just how quickly they can turn on supply through developments and what have you, and what industry is doing, what is the economy doing, what are the drivers of the economy. So once again, wouldn't be a heavy Tasmanian portfolio for me, but a sprinkling is okay. Is the time now? I think it's been and gone.
Yeah, and one of the things that we need to keep in mind is that a lot of these short supply in Tasmania has been brought about by the bureaucracy in terms of getting all the DAs approved. I mean, the DAs over there take substantially longer, and therefore that's created that supply and demand ratio, because we're not able to build as rapidly as you would like to, and therefore that's pushing the rents up. And you got to ask yourself the question: once they've solved that issue, what's going to happen then? Are we back to normal Tasmania? And then you look at it historically, every time Melbourne and Sydney have gone through its peak, areas like Tasmania and areas like any lifestyle areas, Tasmania, Cairns, all of these areas, they have also then started taking off because people are equity rich, and they then start looking at both cash flow and the wow factor, the holiday factor of going to these areas and then saying, I like this place, I'm going to buy in here, whether it is for retirement or whether it is for cash flow reasons, and the buying from the heart rather than the head. Combine that with when you look at the general population of Tasmania, we've got a lot more aging population there in comparison to your Brisbane, your Sydney, your Melbourne, your Adelaides, and even your Perth markets. So you won't find that the same metrics that you're looking at in the other areas in Tasmania. And that's why I agree with Steve in the sense that we need to be really strategic in what we're buying there, and looking at it from a long-term view and saying that, okay, will it pan out over the long term, or is my money working far better for me in a different area?
It's funny, property investors and those who have a number of properties, they don't like the idea of having lazy equity or lazy capital. They sit there and
I was just about to mention
they're
that.
they're like a crack addict, right? They want more and more and more, right? So they're going, I've got this money that's not really performing for me, so let me put it somewhere where I think I'm going to get some performance. And whether or not that's the Tasmanian phenomenon, I don't know, but I think there's a bit of that.
I think it is, because I think, though, as you become a more sophisticated investor, you're looking to make your money work for you. Now, whether it's in an offset facility, whether it's paying down this or buying another asset, whatever it may be. But Victor touched on a really good point that as people become equity rich, so let's just talk about Sydney and Melbourne as an example, and over the last 5 to 7 years, a lot of wealth has been generated. And so people's sentiment between their own ears is high, it's good. And so they're looking a lot further into the future and where they can put this wealth that they've created, and let's call that equity. So one day I might want a holiday home in Service Paradise on the canals, whatever it may be. So let's buy that now, because we're equity rich, we're wealth rich, and cash flow and jobs is good. And for me, whilst taking advantage of wealth is relevantly good, thinking that far into the future in terms of perhaps something that's not investment grade isn't so good.
So what's investment grade mean?
Different for everybody. For me, it's something that is going to make me money in the long term, that has all the right fundamentals. Now, some people might call investment grade that has homeowner appeal. But for me, that changes over time as well. So let's take Redfern as an example. Wasn't always homeowner appeal. Let's take the southern corridors, southwestern corridors of Sydney. Wasn't always homeowner appeal. But because of affordability, they eventually do. So for me, investment grade is something that's not going to be oversupplied, something that has a decent cost to operate around it. So we're talking rates, stratas, rental income and the like, and something that will always be in demand, generally speaking, so metropolitan areas.
Okay. South Australia, Adelaide versus regional towns. It's sort of, once you get out of Adelaide, stuff gets pretty small, right?
It does. And for us, Adelaide is 15 minutes from the CBD and probably not much further than that, unless it's a very good reason.
Probably 20-minute max is with an exception.
Yeah. And there's some exciting stuff going on there, but they've also had their knocks as well. And I just noticed today there's another little bit of bad news around employment with, you should know this, who's the shipbuilders down there?
There's been ASC's, big shipbuilder down there. Yeah.
So they've just laid off 90 people.
Yeah.
As of today or soon. Well,
that's going to grow though. I think one of the industries that South Australia has for it is the defence industry, right?
It is.
And they're building submarines and frigates down there. It's going to employ a lot of people and all this sort of thing.
Correct, but people need to understand it's not right now.
It's not right now.
It's in the years to come, so in 2 to 3 years' time.
Well, it's a 50-year program to build and sustain these new submarines, right? It's, the people who are going to be sailing on these submarines aren't even born yet. Putting that into some context is a long, long way away. So you've got to remember that the long-term investability of a locational investment grade is that does it have potential for long-term growth? That's fine, but when does that actually happen?
Correct.
Can you hold a property for that long, or can you wait 10 years and then buy, right?
Yeah, I think Adelaide's okay. It's never going to break records. So I think how you buy it and where you buy it is ever so important there. So you need to be buying a little bit better than everybody else and build that buffer or that mitigation in the purchase price and the location.
So looking at CoreLogic data, Northern Territory, Darwin is probably softening more than everywhere else is softening, and it has been for quite some time. A lot of concerns about that market. Again, it's akin to like a Hobart. It's just a large regional centre. But there is the livability of living in Darwin. Multiple industries, but not as diversified as some of the other capitals. Hasn't really seen a lot in terms of property over the time. Is anything going to happen there? Is always going to be Darwin?
Yeah, it'll always be there. Darwin is very much around timing the market. You need to be so sure that you're getting it right, the right time to get in, and as Vic said earlier on, the right time to perhaps get out as well. And if you're not going to get out, just make sure that you've got plenty of liquidity within your...
To hold it.
Yeah, to hold it.
Yeah.
It's not the type of area for me. I just think there's better places to put my money than Darwin.
Well, that's a good point. Have you been up there looking around a property?
No, I haven't.
No, never been?
Never been there.
Not even the data indicates
you should be out there
to even put time on the ground.
Well, that's going to
You'd have to be on the ground right there, living there, to be able to pick the small fluctuations to make your money. But I agree with Steve. We're not dealing with a large population base, and therefore your money is working far better in the states that have a far bigger population base.
Okay, but so you guys, to segue into it, you've seen the germination of an idea that Western Australia, Perth in particular, is really look at. You've seen some of the data coming through, and you guys have been out there exploring that particular market. We've spoken about it in the past. Has much changed since we last got together? And there was parts of Perth that you guys saw levels of activity which were quite encouraging, and the right sort of assets if you were to secure them. Is there a rush to get there, or time on your side?
I think we've got time on our side, but perhaps not a lot of time. It depends on how you look at Perth in particular. People need to understand, just because the data may indicate that Perth as a whole market has stopped falling doesn't immediately mean that it's going to start to increase in value as well. There might be a flat line for years to come. So for us, Perth and certain parts of it do show promise, but we are still dealing with high vacancy, not just residential but commercial as well, in the city centre. So the stuff that we do in Perth is exact. So we're down to the square metres, down to the road frontage, down to the property type, down to the street, down to the suburb. But we can't take it on as a blanket approach, whereas that rising tide lifts all ships. We need to be precise, and it's not for everybody. We need to look at Perth as, even though we always talk long term, this is something that we can potentially create in the medium term as a form of mitigation.
Okay. So, Victor, we've covered a lot there. Lots of different theories, practices, strategies, concepts. Let's summarise, generalise. Is it a good time to buy property?
There's always the good time to buy property. There's always the right time to buy property. You just have to keep it real and keep it pertinent to what you're trying to achieve and what you've got in the kitty. In other words, how much capital you've got, how much tolerance for negative cash flow, what advisors have you got around you, and whether your own psyche actually helps you in invest. In other words, are you someone that's willing to take a punt and therefore, the first thing that drops in your lap, you pick it up and run and speculate? Or are you methodical? Methodical wins the race all the time.
Okay, so be methodical. So it's a good time to invest in property if you've got everything lined up, so you're prepared and ready to invest in property.
Correct.
It's a good summary. Steve, you need to add?
If your household budget allows you to buy the next one, then certainly entertain it, and as long as it doesn't erode the cash flow and capital buffers. And sometimes going to buy the next property doesn't mean immediately. Sometimes that little portion of consolidation will make you more money than buying anything for the sake of buying it.
And don't feel as though you have to do something.
No, correct.
It's okay to sit on your equity and wait for a rainy day.
Or sometimes you'll make more money by doing nothing.
And I think obviously this is all very general, so there's no advice here in terms of whether or not you should buy property by way of disclaimer, but make sure you've got the right people around you to help you make those decisions. It's absolutely imperative, because in markets that we're operating in right now, particularly Sydney and Melbourne, is when a lot of people, when you fast forward 20 years, probably people will be talking about this period of time saying they did really well. So if you think you're one of them, get yourself ready and prepared to do so. All right, thanks guys. Appreciate your time.
Pleasure.
Really insightful. Remember, check out smartpropertyinvestment.com.au. Plenty of stories and articles around this sort of stuff every single day. If you want it straight to your inbox, you can subscribe so you're the first to know what's going on in property and property investment in Australia. smartpropertyinvestment.com.au/subscribe, or you can follow us on social media and get all your info. That way, just search for Smart Property HQ. Any questions at all around this podcast or anything in general, happy to cover them off. editor@smartpropertyinvestment.com.au. Email us, check it out, and we will respond. Also, please keep those reviews coming on iTunes. We do appreciate them, and let us know what you think about what we're up to and how we're doing it. I guess our purpose is to make sure that we're giving you as much information as possible to make sure you are as informed as possible to make the right investment decisions. So hopefully it's all helping. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.